The global mining industry continues to face unprecedented change. The demand for critical metals continues to surge. As we shift into carbon neutral, but operating environments face a long list of challenges. Interest rates are going up. We've got the threat of recession, which has been hearing from the IMF, suggesting that a third of the globe will go into recession in 2023. How long that lasts, how deep it is, remains to be seen, but certainly that could put a brake on demand. But the big demand center of the last 10 years, China, also still very much in the shadows because of its COVID policy, which we've yet to see any firm evidence that it wants to move away from, although suggestions are that the authorities there are looking at ways of getting people back to work. So what's all this mean for the global mining sector in 2023? Our regular guest is John Meyer from SP Angel. And John, first of all, I want to say a very happy new year to you. What about the new year? What's it going to bring for us that look at these markets as an opportunity to make money?
Well, the first trading day back is always a tough one for forecasts. What we generally get is a fairly strong start to the year across many commodities, and we're seeing that in copper today and gold as well, in fact. So that is as normal. We're expecting a fairly volatile month, 2 months probably. We've spent a lot of time in recent years focusing on China and the growth going on there. And yes, China is although it's gone ex-growth in manufacturing terms, it can recover growth in other areas. And it's worth focusing on where this growth is going to come from going forwards. And I think the US is going to become much more important to us through this year. Biden's managed to get through a bipartisan bill. I think it's $1.7 trillion. So there's a lot of cash going into supporting the underlying US economy. There's a lot of money going into developing grid infrastructure, new electrical power infrastructure, all that sort of stuff. And let's not forget electric vehicles within the mix there, just one of many elements. As China slows, a lot of manufacturing has moved offshore China back into the United States for a number of reasons. The new restrictions on semiconductor sales to anyone who's got any connection with the People's Liberation Army of China is critical here. But of course, that move offshore out of China had started anyway, because China's zero COVID policy was creating all sorts of problems for Western manufacturers, with workers being locked into factories for months on end. That was potentially impacting their rights. So that manufacturing was also moving into not just the US, but other parts of Asia. So these other areas are starting to benefit from China's losses. Now, one of the problems that China's had in recent years, one of the big issues was it said it was going to develop this dual circulation policy, which really means just stimulating local consumption. So it's stimulating people to buy local apartments and houses and stuff like that, and then fitting those apartments with white goods, with all the things that people normally buy. But China, of course, had held back on that policy. It wasn't helping to enrich the middle class and the population as a whole. The guys at the top were really just looking after themselves, sadly. So I think we're now going to see President Xi bring in dual circulation, and that will drive Chinese demand.
Okay, John, I want to pick up on that point about the markets and where things are moving and bring up an index, the FTSE 350 mining index. We can see on the far left-hand side here, we see these COVID lows back at 11,080. And significantly in the last few days, we've just begun to trade above that again after the recent lows that we had taking us down to the lows not seen in several years back in July last year. Then has come this bounce. And of course, you can got this Ukraine invasion point here at 18,840, where we saw this precipitous drop for the index down into those recent lows. Now, I want to focus on that right-hand side of the chart here, because significantly, I think this is for technical analysts particularly, but I think this backs up the point that we've got new higher highs coming at some point later on this year. We've seen this move for the green line over the red line. Now, these are my two major moving averages, the 50-period moving average, which is the green line, moving above the red line, which is a 200-period moving average. Now, this is a golden cross. Now, last time we had a golden death cross was back here in August 2021. We saw these declines come through, and we talk a little bit about the volatility we're expecting. That's exactly what we got there before the big declines coming through. So I'm looking for higher highs, possibly later on in the year. And I think if we get past this 11,916, we will then move up from this point. But I think my question to you, John, is what is it that's going to move that market higher?
Well, some of the stocks in this index got hammered by the situation in Ukraine, and one understands that fund managers want to reduce risk within their portfolios. So they clearly the Ukrainian situation created a massive problem for European manufacturing, which was largely dependent on Russian gas. Now that Germany and France have moved a long way away down the track from getting away from Russian gas, they having moved into using gas in recent years, they've now moved back into using liquid natural gas, which is coming into Germany, and diesel fuel. Of course, there's still some exposure to Russia there, but thankfully, oil prices have come down. Brent oil is at $85 today. So we're a long way off the 120, 130 that we were looking at 6 months ago. That helps reduce inflation. The ECB, the European Central Bank, is unlikely to raise rates very far in this environment. So I think Europe is still going to focus on trying to reduce the impact of the Ukrainian crisis. Sadly, both sides are throwing a lot of metal at each other, which is never a good thing. But both sides, the West and Russia, are increasingly gearing up to produce more and more armaments. That will create a certain amount of demand. But for me, the bigger amounts of demand are going to be the reconstruction of US infrastructure, not just the US grid, which is very important, but other parts of US infrastructure which have been neglected for many, many years, and also the development of dual circulation in China. So the thing we have to watch out for right now, and the reason why we're all a bit uncertain about where the world is going, is because China has decided to throw open the floodgates, that everybody in China should catch COVID immediately, that they will hide the statistics on how many people are actually dying from it. But this COVID surge is going to disrupt the Chinese economy quite a lot, at least until the end of the Lunar New Year. So what are we talking, the 6th or 7th of February? And then at that point, we need to see, well, how's China doing here? Have they all had COVID? Have they got over it now? Or are they going to see ongoing disruption for another 3 or 6 months after that? I think either way, China is going to carry on stimulating its property sector. We're already seeing that, and stimulating the dual circulation policy to encourage local people to buy Chinese goods that are not being bought by Western retailers. So the West has slowed down a lot of its purchases for China. That's caused factories to close, things like a lot of furniture, that sort of stuff. Because inventories had built up a bit too high over here, and demand had also fallen away. But I think a lot of this, where metals are concerned, we think of fridges, freezers, air conditioning units are a big consumer of copper, for example. I think the demand will still be there. And on top of that, we're going to see more and more electric vehicles. It's not just Tesla anymore. I see that BYD, where Warren Buffett invests and holds about 20%, they're actually producing more electric vehicles than Tesla now. So you've got a number of big players in this market, all vying to own the electric vehicle space going forwards, and all consuming huge amounts of metal.
Just one final question, if I can. It steers us away a little bit from mainline mining, but it just talks about London as the home market, if you like, for capital for this particular sector. Because we've been in this job 30 odd years or so, and we know London as the centre of the world. Mining companies come to London to raise money. They come to London to list. London has benefited from these mining companies on the main indices. Do you see London continuing that role as one of the pivotal markets for this sector, or do you think, like we're now hearing within the finance sector, that it's beginning to drift away offshore for whatever reason to whatever other jurisdiction, be it Brexit or be it a sluggish economy or other factors that might add up to a negativity for some companies wanting to list here. Do you see London continuing to hold the flag for global mining?
Absolutely. I don't see Brexit as an issue for this. Capital flows to wherever it can be most efficiently put to work. London is still a huge centre for that. There's a lot of mining project finance expertise in London, and the companies are going to want to be close to that. So yes, this is very much a global centre. It's much more so than many other parts of the world. It ranks alongside Australia, which has been doing well, and Canada, which has a strong mining tradition. But still, it's seen as very much a growth market for mining companies to incubate in and to then move further up the value chain.
John, we'll have to leave it there, but thanks indeed for your outlook for 2023.
Thank you, Jeremy.
John Meyer there from SP Angel with his outlook for the mining sector as we see things develop at the beginning of this new year.